Hi, this is Kanwal Sarai, and welcome to the Simply Investing course. I've put together this one-of-a-kind course to help you get started quickly and become a very successful investor. This course is divided into the following 5 modules. In Module 1, there is a brief introduction about myself, and we're going to go over some of the investing myths, and then we'll talk about what is a stock, what is a dividend, what is a stock market, and what is value investing. In Module 2, we're going to be covering the 12 rules of Simply Investing. In Module 3, we're going to talk about Plan A and then Plan B. I know it sounds a little mysterious right now, Plan A and B, but once we get to Module 3 and 4, you'll have a better understanding of what it's all about. Module 5, when should you sell a stock? Which is very, very important. This is just as important as knowing when to buy a stock. And then we're going to cover a little bit about mutual funds and then building a portfolio, tracking a portfolio, managing risk, and then we'll finish off again with some of the investing myths that we discussed in Module 1. So what will you learn in this course? You will learn through responsible investing how to make money by creating a new stream of income and through capital gains. You're going to learn how to maximize your profit and minimize your risk. Now, before we begin, I want to tell you a little bit about myself. I first started investing in 1988, starting with a term deposit, or here in Canada we call them GICs, Guaranteed Investment Certificates. I then moved on to mutual funds, ETFs, and stocks. I basically spent the first 10 years from 1988 to 98 in mutual funds. There's some on the screen here that you can see. There was lots more that I had bought, and I went to see financial advisors, financial planners, both the ones that you meet at the bank and they sit down with you, or the ones that come to your home and put together a financial plan. But basically, I got to tell you, after 10 years of being a mutual fund investor, I became more and more dissatisfied with the performance of my mutual funds. Take a look at the charts on the screen, those 2 charts. Those clearly represent where I went over the course of 10 years investing in mutual funds. Some of the funds would go up, then they would go down, but mostly down. So my returns were pretty dismal, and I decided to start investing in stocks. And that didn't go too well either. In 98 we had a technology bubble that started, and I had no idea what I was doing. I was going by advice from family and friends and what I read in the newspaper and heard on the radio. Basically, at that time, anything with a .com name attached to it, you name it, Amazon.com, Yahoo, Cisco, all of these high-tech companies, they were all going up, up, and up. Basically, you could buy a stock for $20 on a Monday and sell it on a Friday for $47. So everybody around me was making money. People around me at work were making money. So I got into it. No idea what I was doing. And luckily I didn't put too much money into it, because when the technology bubble burst, all of the stock prices came down and they all crashed. And I'll just give you a very quick, short little story, a real life story with a company called Nortel Networks. Luckily I didn't buy any shares at its peak, but at its peak the shares were trading at about $120 a share. Then they eventually went down to $80, $60, $40, $20, and then eventually down to just a couple of dollars. At one point I believe there were also 85 cents. Anyways, to make a long story short, the company eventually ended up going bankrupt. So I realized then that for me to become a successful investor, I had to pick role models and learn from them. Learn from their mistakes and successes. Why reinvent the wheel when I could learn from them and just copy what they did? It's no secret. There's tons and tons of books written on this topic, and you just have to go through them and do the research, and you'll find that there is no big secret, and you don't have to be a rocket scientist to be able to do what these successful investors have done. So I had to find some role models, and I had to find role models, who didn't win the lottery, who didn't inherit lots of money, or had rich parents. They had to be role models who became successful based entirely on their own skill, and they had to have a successful long-term track record. Not somebody who made lots of money in 6 months or a year and then lost it all. These successful investors had to have consistently made money over the long term. I'm talking about 20, 30, 40, 50 years or more. So I did some research, and the following two people kept showing up over and over again. Do you know who they are? That's Warren Buffett and Benjamin Graham. Warren Buffett is one of the richest men in the world today, a self-made billionaire who's the most famous stock investor of all time. And Benjamin Graham, who was Warren Buffett's teacher and mentor at Columbia University. Benjamin Graham is known as the father of value investing. He wrote a book in 1949 called The Intelligent Investor, and what he wrote more than 60 years ago is still true today. It's funny, history has a way of repeating itself, and so all of this technology bubble and all these different industries that have crashed and then come up again and crashed and come up again, it's incredible. It's in this book, and all you need to do is replace the company names with the companies that exist today, and you'll see the same mistakes that investors repeat over and over again. So it is a very incredible book. I do recommend it, but it is a big book to read, and probably not for beginners, but if you ever come across it, do take a look at it. And there are many more famous and not so famous investors. I've put a couple of them on the screen here that you can see. So pretty much I spent the next 3 years researching the best investors of all time. I interviewed other value investors, read dozens and dozens of books on the subject of investing. And all of these books, all of this research that I did came to the same conclusion. That value investing was the way to go. And if you were going to become a successful investor, you had to do it yourself. You should not rely on banks or mutual fund companies or financial planners to make you successful. You had to do it yourself, and it was easy. It wasn't time consuming. It wasn't, you didn't have to spend hours and hours researching things. You could easily do it on your own. Anybody could do it. And that's what my research showed. So I started investing in stocks again. But this time I started investing responsibly, and I knew what I was doing. So you can take a look at our website, simplyinvesting.com. We've got our track record there for over a decade of being a value investor, and you can see we've done very well. You can also look on the web. You can do Google searches on any of these folks or other value investors, and you can see that they're quietly, making money consistently year after year, and they're very successful. Just they don't make the news, right? You can see in the newspapers, bad news sells papers, sells TV ratings. So value investors do not make the news, but they are out there. There's thousands and thousands of them out there, and they're very successful. So what I've done is I've taken all of my investing knowledge and experience and put it together in this extraordinary course. This course will give you everything you need to become a successful value investor. So let's get started. What are some of the negative myths surrounding investing? When you tell somebody or you tell some of your friends, hey, I'm starting to invest in the stock market, I'm going to be buying stocks and shares, what do they usually think? What are some of the negative things that they think about? The first thing that comes to people's minds is that investing is risky. It's like gambling. The other thing is people are going to say, well, it's time consuming. You're going to have to spend hours and hours analyzing stock reports. It's going to take forever. And the other one that I see is people will say, well, it's too complicated. It's like rocket science. You need a degree in finance, you need a PhD in economics to be able to become a successful investor. And you know what? Investing is risky, complicated, and time consuming if you don't know what you're doing. Which is why you're taking this course, to minimize the risk, make it simple, and save you time. So now I'm going to go through 3 definitions with you. Some of you may already know what this stuff is, but I need to make sure that we're all on the same page before we sort of get into the deeper into the course. So what is a stock or a share? I'm going to use these terms interchangeably because they mean the same thing. A stock or a share represents ownership of a company. In reality, it's just a piece of paper. It's a stock certificate. But what it represents is ownership in a company. Now, for example, Microsoft has a little over 8.7 billion shares outstanding. So if you own one share, you own 1.87 billionth of the company. If you were to buy all the shares, then you would own the entire company. So as the owner of the company, you're entitled to certain rights. Number one, you're going to be invited to the annual shareholders meeting every year. You may or may not wish to attend. Entirely up to you. Secondly, you're entitled to dividends. And that brings us to the next slide. What is a dividend? As part owner of the company, you are entitled to the company's profits. Dividends are cash payments made out to all shareholders. Basically, the company is sharing profits with you, the shareholder. For example, if a company is paying out $1 in dividends per share, and you own 100 shares, you're going to receive $100 cash every year for as long as you own those shares and as long as the company pays out the dividends. So for example, if you own 1,000 shares and the dividend is $1 per share, you're going to receive $1,000 every year, cash, as long as you own those shares and as long as the company continues to pay out the dividend. So we're going to see a little later in the course that this can amount to thousands and thousands of dollars. I mean, it probably sounds like peanuts here, $1 dividend or 25 cents per dividend, but hang in there. We're going to see in module 2 how these dividends can really add up. And the last definition here is, what is a stock market? Basically, it's a place where stocks are bought and sold. You might have seen this picture on television or in the movies. This is the trading floor of the New York Stock Exchange. And you see people run around yelling with pieces of paper in their hands and yelling out buy and sell orders. Well, fortunately for us, with the advent of the internet, we can now buy and sell stocks from the comfort of our own home without having to physically go to the stock market. The two stock markets that we're going to focus on, the first one is the New York Stock Exchange. This is where all of the US company shares are traded, most large US companies. For example, Microsoft, McDonald's, Walmart, Ford, Pepsi, they all trade on the New York Stock Exchange. Most Canadian companies, like Bell Canada, Rogers, TELUS, Loblaws, Petro-Canada, they all trade on the Toronto Stock Exchange. So what is value investing? This is what the entire course is based on. And you can easily Google this and you can find hundreds and hundreds of books written on this topic, but I've distilled it down to one sentence. Value investing is buying quality stocks when they're undervalued. Okay, remember the two key terms here: quality and undervalued. Okay, we've all heard the term buy low and sell high. So what does that really mean? I mean, why do you want to buy low and sell high? Okay, take a look at this example here. You want to buy low and sell high because that's where you're going to maximize your profit, right? You want to buy the stock at $14 a share in this example, and that's where it's low, it's undervalued at $14, and you want to sell it at 51 because you want to sell it high, and that's where you're going to maximize your profit. If you buy this stock at $50 or at $49 or $50, there's not much room for you to make any money there. So you want to buy low and sell high because that's where you're going to make the most amount of money. So how do you know when a stock is undervalued, and how do you know when it's a quality stock? So to help you figure that out, I've created what I call the 12 rules of simply investing. And we're going to be covering these in the next module.